Hey guys, thank you for tuning in to Talk Finance. My name is John, and we're going to be talking about some different options, specifically with this SoFi current option that I just did, as well as an IIPR or Innovative Industrial Properties option that I ran as well. So SoFi has been fluctuating for the past 3 weeks between $4.30 and $4.87. And I do think that SoFi has potential to become a good investment if you plan to hold it for the next 5 to 10 years, with some returns from selling it in as little as 2 years. I currently hold around 250 shares of SoFi and not looking to sell anytime soon. Depending on the price, I will buy more shares of SoFi, but we should be able to adjust our buying and selling strategies when new information is given to us and always see if our investment still makes sense. I am currently using options to make a return on SoFi. For now, I sell puts and calls. I run an options play similar to a straddle position. So I'll show you a chart right now. It's if you buy, let's say, 100 shares of XYZ stock at $100. You sell one XYZ 100 call at $3.25. But at the same time, you're selling one XYZ 100. So you're getting 100 shares for every put or call contract that you are selling at $3.15. So that's a 10-cent difference. So a covered straddle position is created by buying or owning stock and selling both at the money call and at the money put. The position profits if the underlying stock trades above the break-even point. But profit potential is limited. Potential loss is substantial and leveraged if the stock price falls below the break-even point. Losses are $2 per share for each $1 decline in stock price because both the long stock and the short put lose as the stock price declines. Note that the short put is not covered as the strategy name implies because cash is not held in reserve to buy additional shares. Now, what I did in exchange of it, I sold a covered call and I sold a cash covered put. So it's a little bit different because I am covering both ends. There's no unlimited loss. What I did instead of just selling a call or selling a put is I sold the put at $4.50 because I feel comfortable buying it at $4.50. So if it were to call at $4.50, that's perfectly fine. I'm comfortable buying it at that price. And I sold the call at $5 because if I just bought 100 shares at $4 previously when I ran another put option, or I sold another put, and if I were to sell them at $5, I know I'm making $1 per share in profit. So I'll make $100 in that, plus I collected a premium. Now for selling it at $4.50, the put at $4.50, I made a premium of $31. And selling the call at $5, I made a premium of $12. So right there, I made $33 just selling a call and selling a put. So a thing to remember is when you are selling a put and you're selling a call, you are collecting a premium. Now that premium is important because it does give you an idea of if the share price were to drop to, let's say, $4, I'm going to get called on that put if I did not close out the position. So at $4.50, I am losing 50 cents a share on that price. But I said, hey, you know what? I feel comfortable owning it at $4.50. I know it will be worth more than that. And it has been fluctuating, going up and down, obviously, past that $4.50. If I were to sell the call at $5, it's not ideal, but I would be making a profit there because I have purchased shares at $4 before. So by buying and selling, I can make some premium on the call and on the put that I sold. And if neither of them get called, that's great. I still get to keep the premium, and I get to resell again, and I will only sell them where I feel comfortable. As of now, if I were not to be called on these contracts, I would then put the shares on sale again. My idea is to buy a few more shares before I believe the price will go up. So if it does get called at $4.50, that's great. If the price goes down and I do not get called at $4.50, I will sell another contract at a lower price, let's say $4. The point is to sell it close enough where you can still make a good premium. But if you're looking mainly for the premium, you do have to understand that there is a risk associated with selling close to the money. So another thing I do want to remind you guys is that this is not financial advice, and I'm just letting you know of some of the strategies that I use. But I am a long-term investor. I'm not a day trader, but being newer to options, I like to try and sell some calls and puts when the price is moving within a specific range. So the best way these strategies work is, if you notice the past 3 weeks, SoFi has been staying very steady in the price range that I said earlier, $4.30 and $4.87. So it's been fluctuating there. So if I were to sell over five call, I know that most likely it won't be called, but you never know. Something could happen in the news, a new update on the company, and it could just skyrocket. So you are running the risk. So you should feel safe that, hey, if it does hit that $5, at least you're making money. You're still selling above what you intended. Same holds true if you're selling a put and you're selling it at $4.50. You better be ready to buy that at $4.50. If it doesn't get called, and that's your main expectation, that you don't want it to get called, that contract, then that's great. But if it does get called and you don't close that contract, you have to be ready to do that. If you weren't ready to buy that contract, you say, you know what, I got new information, I don't believe this is a good investment anymore, you can always buy back the contract. So you can actually buy to close. So just like with any other, investment, options trading can be risky. So I always say, you know what, get comfortable with it. You can always start with something small, something safe. You can start a way out of the money call or a way out of the money put. When you do that, you can go ahead and get your feet wet and just say, you know what, I feel comfortable selling at this price. If it were to hit this price and I'm still collecting a premium. So let's say you were called for something small. You were selling it at $5 and the stock sold at $5.25. Well, you really didn't sell at $5 because you collected a premium. So you sold over $5 a little bit. So the main risk of selling a covered call is the future potential. So we're talking about, what if that price went all the way up to $10? You're losing on $5 per share. That is the risk that you run when you have a covered call. You can always repurchase that call. You can buy and close that call, but you have to remember that you will pay a premium because it would be over what you originally sold that call for. So what I'm saying is, you should do your due diligence as well. You should see if this is a good play for you. And this can work with a lot of other stocks. So for example, I myself have an innovative industrial properties. Now, as you can see on here, it's currently going for $112.20 a share. The great thing about innovative industrial properties is that currently it's a stock that has been fluctuating like crazy. It's been going up, it's been going down. At one point, it was like $250 a share. It dropped down to like $95 a share. It's currently at $112, and it seems a lot more stable at that price. But if you look at the options here and what the prices are, the strike prices, so if you were to, let's say, get something at $110 with the current price of $112, obviously you're going to be running a huge risk that you might get called on this if you're selling a put. So if you sell a put, though, and you look at the price, you could get $600, $670 for selling this. So I sold a $100 put with an expiration date of January 20th. So at $100, a cash covered put of $100. So on here, it only goes as low as $105, but I sold it for $100, and the price was $200 for those 100 shares for that contract. So I got a premium of $200 for selling a put at the $100 mark. Now, the current price is $112.20. From what I've been seeing, is I don't think it will hit $100 or below by January 20th, but if it does, I feel comfortable buying it at that price range because I know it's worth more than that, and it will probably go back up, and I can sell it as a call. And then if I sell it as a call, I could sell it, let's say, at $105 and make a profit of $5 a share. And on top of that, I would be getting whatever the price would be at that time, a month out. IIPR, Innovative Industrial Properties, I think it's a good play if you want high premiums, but it's a really risky stock. We're talking about a stock that's gone from $250 to $95 to currently straddling and jumping around the $100 to $120 mark. And right now, I played a $100 strike price for this. So I sold a put at $100, and I sold it at about $200. So it was a $100 play for $200. I kept it kind of safe, hoping that it would not be called at 100. It would not drop to 100 and get called. But if it were to drop it to 100 and I get called on innovative industrial properties, I'm fine with that. You know why? Because I have invested in innovative industrial properties. I bought it back when they were like $180 to $200 a share. So it was definitely way higher. So right now, if I were to dollar cost average, this would be a great entrance fee. So I paid about, obviously I paid $10,000. I didn't actually pay it, but what you do is you hold it in your investment account, and that becomes pretty much a cover to be able to say that you have the money to purchase these shares. So obviously the strike price being $100, that means that you would have to have $10,000 in reserve to cover that $100, because you're buying $100 in each share would be $100. So you would have to buy 100 shares at $100, even if the price dropped at $95. That is a little bit about the options plays that I'm currently running, and together overall with innovative industrial properties play plus the SoFi play, I currently sit at $233 in profit for the month of December for running a 3-week play with SoFi and a 1-month play with innovative industrial property. And I plan on doing that again next month and possibly closing and buying out those contracts before the end of the month, as long as I'm up on those contracts. So I can close them earlier. If I see them going my way, I will just let them expire worthless. If I see that it keeps fluctuating up and down and I can still make a profit by closing them, I might do that as well. But as it gets closer to the strike price, as you get closer to the date that the contracts expire, obviously the contracts lose a lot of their value. So if you can get as close as possible to that date, either let them expire worthless, or you're looking to purchase those at that price, or you feel, hey, you know what, they're going to drop way more than the $100, and you feel like, you know what, it's better that right now it's up, I'm going to close this contract, and then once you close that contract, you can then rebuy and purchase it when you feel ready that price has kind of leveled off, and that's how you can make a profit off of selling and buying options. You have to be very careful to not jump the gun and try to scare yourself with every piece of news that's out there. So you have to be ready to and understand that there's going to be day-to-day fluctuations, but that's why 3 weeks or a month gives you some breathing room to not have to worry about, hey, what's the price going to be this week? Is the news going to really affect it? You can kind of have a long-term play where you're seeing the price fluctuate, but you are able to say, you know what, I think 3 weeks from now or a month from now, it's going to be a good play, because a week from now something happens where it's like, oh no, the price crashed because something came out in the news. Well, guess what? Next week, you don't even have to worry about that, because all of a sudden the price fixed itself. They said it wasn't that big of a deal. Hey, a CPI report came out. Everyone freaks out, or everyone thinks it's awesome, and then the market crashes because everyone's trying to sell everything. So, this gives you a little bit of an idea of what that could look like. And you always have some time to, like I said, buy those contracts back or close those contracts. And remember, I'm not telling you to buy, sell, or hold SoFi stock. I myself do hold some shares of SoFi. Like I said, I hold around 250 shares, but it's not a large part of my portfolio by any means. I prefer to buy dividend-paying companies, both qualified and non-qualified dividend-paying companies, but do invest in some growth and value companies as well to diversify my portfolio. I believe that dividends is a great way, especially in the market when it's unknown, you don't know where it's going. You put your money in safe investments like dividend companies. You diversify even in those dividend companies. I myself hold a lot of companies like Stag, which is Realty Income, Maine as well. I hold Microsoft, and I hold a few other dividend companies that are just like Microsoft, where they're qualified dividends, so I can make sure that I'm not getting taxed every single dividend that I have out there, because REITs will be taxed at regular income. So you have to remember that, as safe as they feel. I'm not going to say that, investing in a REIT is a terrible idea because of taxes, because I think investing in REITs is great. I think it's a safer choice. It's not the safest choice out there, but it's a safe choice. But I put a lot of money in my main investment is still VTI. And that's one of Vanguard's total stock market ETFs. Been buying that since I started investing, even when everyone was talking about VOO, which is another great investment that tracks the S&P 500. I just believe VTI has more potential for longer growth, tracking all of the stock markets here in the United States. If you found this quick video helpful, please give us a like, and remember to subscribe. It does help out the channel and lets us know if you're interested in this type of content. Don't forget to comment, let me know if you have any questions, and see you guys next time.